There is a quiet, almost invisible misconception that floats around whenever people start talking about the stock market. It's the seductive idea that making money in stocks is, inherently, a simple thing. The narrative we are sold is that all it really takes is picking the right company, waiting a little while, and casually watching your money grow. Social media certainly doesn't help with this illusion. Every day, we are bombarded with highlight reels of massive, unprecedented gains. We see the overnight success stories, the screenshots of portfolios in the green, and the charismatic influencers claiming they turned a tiny, insignificant account into life-changing wealth from their living room. But here's the deeply uncomfortable truth. Most people do not make money in the stock market. In fact, a staggering percentage of individual investors either vastly underperform the broader market or they lose their hard-earned money altogether. So, what is actually going on here? Why do so many incredibly smart, capable people fail at something that seems so straightforward? The answer is not bad luck. It is not some shadowy, hidden conspiracy orchestrated by Wall Street elites. And it is definitely not because the market is fundamentally rigged against the little guy. The real reasons are much simpler, much closer to home, and deeply, undeniably psychological. It starts with the fact that the stock market is one of the few arenas in modern life where human emotions are relentlessly tested on a public stage. Fear, greed, excitement, and panic, they all show up at the absolute worst moments. When stock prices are climbing quickly, people naturally feel greedy. They see others making money, and a deep, visceral fear of missing out takes over. This FOMO is a powerful drug that overrides logic. So, they jump in late, right when prices are already peaking. Then, the inevitable happens. The market drops. Suddenly, the euphoria turns to desperation. They panic and sell at the bottom. This destructive cycle of buying high and selling low feels like survival in the moment, but it quietly destroys long-term returns. We are biologically wired to run from danger and move toward rewards, but in the stock market, those primitive instincts lead to financial ruin. This emotional volatility is compounded by a severe lack of patience. The stock market rewards time, but we live in an era of instant gratification. We want results now. People enter the market expecting rapid, life-altering gains in weeks or months. When that doesn't happen, they get frustrated. They start jumping from one stock to another, constantly chasing whatever is currently hot. They are always looking for the next moonshot. But true investing is not about frantic movement. Wealth is built painstakingly slowly through the magic of compounding. It happens by staying invested even when nothing exciting is happening. The problem is that slow growth feels boring, and boredom leads to bad, impulsive decisions. People start overtrading to feel a rush, taking unnecessary risks and abandoning solid investments simply because they aren't moving fast enough. In trying to speed the process up, they almost always end up going backward. This impatience leads directly into the trap of chasing hype instead of value. Every year, there is a can't-miss opportunity that everyone at the dinner party is talking about. Millions rush in, not because they understand the business, but because of a herd mentality. This is how bubbles form. Prices skyrocket because of attention, not tangible value. Eventually, reality catches up. The prices fall, and the latecomers are left holding the losses. The pattern is predictable. Early investors make money, and late investors fund those gains. They are buying a story, not a business, and stories always have an ending. Underlying all of this is a fundamental lack of knowledge. Many people confidently throw their money into the market without having the slightest understanding of how it actually works. They don't know how to evaluate a company's health or what drives stock prices. They treat the market like a video game where you just press buttons and wait for the score to go up. Because they lack this foundation, they rely on dangerous shortcuts, like tips from friends or flashy influencers. When these tips fail, there is no strategy to fall back on, only confusion. Confusion in the financial markets always leads to erratic decisions. The market is incredibly unforgiving when you don't know what you're doing. Without knowledge, risk doesn't just exist, it multiplies. You aren't investing, you are gambling with a blindfold on. Then there is the subtle trap of overconfidence. This usually happens right after a few lucky early wins. Imagine someone buys a stock and makes a quick profit. Suddenly they believe they have figured the market out. They think they have a gift for picking winners. Because of this newfound swagger, they start taking much bigger risks and investing larger amounts of capital. They stop doing research because they believe their intuition is flawless. But short-term success is rarely about skill. More often, it's just being in the right place at the right time. Overconfidence blinds people to downside risk, and the market has a remarkably efficient way of exposing anyone who thinks they are invincible. Equally dangerous is the futile attempt to perfectly time the market. People are obsessed with trying to buy at the absolute lowest point and sell at the highest. In theory, it sounds logical. In reality, it is practically impossible. Even professional investors with billion-dollar algorithms struggle with this. The market reacts to a million factors: economic data, global events, and interest rates. By the time a trend is obvious, it is usually already priced in. People sit on the sidelines waiting for the perfect moment that never comes. Or they sell far too early because they are convinced a crash is coming, only to watch the market keep rising for years. Time in the market is always more important than timing the market, yet people continue to try and beat the clock. While chasing gains, most amateurs completely ignore risk management. They focus entirely on the upside, never considering what happens if they are wrong. They put too much money into a single stock or fail to diversify. They don't have an exit plan. When something goes wrong, the losses hit with devastating force. Professional investors manage risk first. They understand that staying in the game is more important than winning every single time. If you lose 50% of your capital, you need a 100% gain just to get back to even. The math of loss is much harsher than the math of gain. It also doesn't help that we are bombarded by a relentless stream of short-term noise. Financial news networks thrive on crisis and hyperbole to keep your attention, but the vast majority of daily market movement doesn't matter. It's just the market breathing. The error happens when people treat every dip as a signal of collapse. This leads to perpetual overreaction, buying and selling too frequently and changing strategies based on temporary conditions. Instead of focusing on long-term trends, they get lost in the static, which manufactures unnecessary panic. This lack of focus is usually the result of venturing into the market without a clear, defined strategy. Too many people are investing without a financial GPS. They are buying stocks without knowing why or having a plan for when to sell. Because they lack a framework, every decision is reactive. They are flying blind, making choices based on a morning mood or a scary tweet. Successful investing is fiercely intentional. It requires a rigid strategy that you stick to even when it's uncomfortable. Whether it's index funds, dividends, or growth stocks, your approach must be defined. Without that structure, you are faced with uncertainty, and uncertainty always breeds inconsistency. You cannot build wealth on a foundation of vibes. Perhaps the most profound reason people fail is a total misunderstanding of what the market actually is. Many view it as a digital slot machine, a place for quick, effortless cash. They see symbols on a screen, not businesses in the real world. But at its core, the stock market is a system for owning parts of real, breathing businesses. When you buy a share, you are a co-owner of a company's factories, intellectual property, and future profits. Real companies do not double in size overnight. They grow over years by expanding, hiring, and solving problems. That fundamental growth is where sustainable returns come from. If you treat the market like a casino, the house will eventually win. But if you treat it as a place to acquire ownership in great businesses, your investing leads to stable growth. When you step back, the truth becomes clear. Most people do not lose money because the system is unfair. They lose because of how they interact with it. They let raw emotions drive decisions, chase fleeting trends, and seek excitement instead of boring consistency. They react impulsively instead of planning strategically. All of those small behaviors quietly compound into massive financial losses over time. But here's the flip side. The exact same market that causes people to lose money also creates immense wealth. The stock market is arguably the greatest wealth creation machine ever invented. The dividing line between winners and losers is not access to tools. It is behavior. The people who succeed in the long run aren't necessarily the smartest. They are simply the most disciplined. They are the ones who stay patient when everyone else is rushing to the exits. They ignore the noise and trust in the long-term trajectory of human progress. Successful investing is not about being right all the time. It is about being emotionally and strategically consistent. The market rewards discipline and stubborn patience, not activity or shortcuts. So if you want to understand why most people lose money, realize it's because they are playing the wrong game. Once you see that, you realize the market isn't the problem. The strategy is. Right now, you have a choice. You can keep chasing quick wins like a gambler, or you can start building real wealth like an investor. And here's the truth most people realize too late. The market doesn't reward hype forever. It rewards patience, discipline, and consistency. And your behavior is the one thing you have the absolute power to change today. You can decide right now to stop being a gambler and start being an investor. The market is waiting. The question is, are you ready?